Hi everyone, and welcome to Talk to the Expert at PROPERTYG.co.nz. Today we have with us Lisa Datson from I Find Property Buyers Agents and Property Finders. Lisa is the co-owners of I Find Property. Welcome to this Talk to the Expert interview, Lisa. We would like to discuss with you today to hear your opinion about capital growth versus cash flow. What should investors concentrate on?
Well, I think it's interesting because there's two ways that you make money in property investment, and at the end of the day, the only reason we go into property investment, or what I would imagine most people would be is to make money. Okay, so two ways that you make money out of investment properties. The first is capital growth or equity, and the second is cash flow or income. So if we just look at the equity first, okay, so there's a couple of ways that you can create equity in a rental property. The first is buying below its value, which is quite easy to do in a depressed market. In the current market, much harder to do. So that may be, let's say you find something for $300,000 and you buy it for $280,000. So that's giving you some equity. The second way is to maybe buy a little bit below value, but also add some value. So you maybe spend $5,000 on the property, but increase the value by another $20,000. And then the third way, which is where a lot of people think about, is on the long-term capital growth. Now the reality is in New Zealand today that if you worked on about 5% capital growth over the long term, you're probably on the money, and you shouldn't have any nasty surprises. And that's made up of the theory that over the long term, property investment after inflation's been taken out has averaged about 2.5% growth. And if we look at inflation about where that's averaged, that's around about 2.5% average. So I think if you work on about 5% capital growth per annum averaged out over a long period of time, you should be able to estimate what the property would be worth in the future. Okay, so that's the equity side of it. So in summary, three things. So buying below value, adding value, and the long-term capital growth. The income side of it is simply the amount of rent that you receive per annum, less the expenses that you have and what's actually left in your hand at the end of the day. Now that used to be a little bit better than what it is today because of all the tax advantages that property used to bring, but most of them aren't available like they used to be. So what we've got to do is we've got to balance our sort of equity requirements and our income requirements. Now if you're a high income earner, you can afford to buy a property, let's say, that had some negative cash flow and look more towards the capital growth side. But the challenge is for a lot of people is that they don't necessarily have that spare income, so they really want to make sure that the property they buy has got enough income so that it supports itself. Okay? So it's always a balance between these two things. The number one area that most property investors get into trouble with in property is lack of cash flow. So it's just understanding the relationship between the two. Ideally you want a combination of both over your portfolio over the long term, but again you've got to take it back to your own personal circumstances and say, okay, well what can I afford to do and what's going to be best for me over the long term.
Absolutely. And low interest rates like we're experiencing at the moment does support lower yielding property a bit, but for the long terms and protecting yourself from fluctuating interest rate in the future, in the medium term, targeting properties with 7 to 8% plus yields is the key. So thank you very much for that, Lisa. Great to have you here.